Hello and welcome to another Livewire CIO profile. My name's James Marley. I'm a co-founder and executive director at Livewire. My guest today is Ben Griffiths. He's the portfolio manager and founder of Griffiths Group, one of Australia's most enduring and successful small cap managers. In today's interview, Ben's going to take us through all the tools that he uses to navigate the small cap market, share a few of the war stories that he's picked up along the way, and he'll let us in on a little secret. He reckons the market does ring a bell at the top and the bottom. You've just got to know what to listen to. I hope you enjoy the interview.
Brian Ely and myself co-founded Griffiths Group back in late 2002, and it really was, I guess, the beginning of, for us, launching our own fund and investing our way and setting forth on a journey that I've always wanted to do. Brian Ely and I had always shared a great love and passion for stocks, investing with discipline, importantly. And that had been something that had been drummed into me, having had a number of years on the institutional side of investing, where you learn the skills as to how to manage big licks of money. So we set course in late 2002, open to retail investors slowly. 2003 was our first full year. As you can imagine, that was we were still supposed to be in the teeth of the dot-com collapse, which started in 2000. So that's the brief background. The fund has grown successfully through performance and inflow, very popular with wholesale investors as well as retail investors. But it comes back to you're only going to do a good job of being a fund manager if you really have a passion and you have an energy and you have a zeal for investing in stocks. If you haven't got that, if you just want to work for wages, don't go into the funds management business and don't go out on your own.
So you talked there about wanting to invest your way. Like, in a snapshot, what is your way?
Yeah, well, my way is always having a regard for value. At every point in time in the cycle, you've got to know about where valuation sits. So having an eye to value is important. And at work, at Griffiths Group, we have a very, very professional and proficient process that drills down on valuation methodologies based on P ratios and forecast 3-year earnings per share growth. And we also pick up on critiquing of management and critiquing of industry structure. And so we combine the disciplines of a quantitative assessment, your PE versus your growth, and then combine that with a qualitative assessment on industry and management. Are we backing the right team? Have we got the right CEO? Is the CEO aligned? And the combination of those filters generates, in our process, a score. If your score is strong enough, you're in the portfolio. And I guess those very principles, to some extent, have always been a part of my investing, even as a young fella. When I first bought my first BHP shares and my first Ansett transport industry shares, always had an eye of who's managing this business, what are the immediate outlook and the prospects for that business, and am I paying too much for it? They're the important ingredients, and to be a successful manager, you can't stray too far from that.
Was there someone in your early days that instilled those principles on you, or is this something you developed yourself?
I think my father bought me one Christmas 25 BHP shares back in the day, and that was a lot of money. And he said, get in the habit of accumulating growth assets. You might as well get started. You and your brother might as well get started early. Here's a start with some BHP shares, Australia's biggest company, or was at the time. Yeah. And get in the habit of accumulating growth assets. And I guess from that point onwards, I did do that, but I became a bit more creative. I cast the net further away from just big companies and actually got myself down in the weeds. Even as an early investor, I was looking to buy exciting stories that had other catalysts, valuation and qualitative attributes, tick. But there are other things too, possible takeovers and possible international acquisitions. There's all those sorts of things. And I was doing this stuff in year 11 and year 12 at high school. I was building my own portfolio out. I was thinking about what makes a stock market drive. I was really enjoying it at that early stage, when really I look back at it, I didn't have a lot of idea, but I had the rudiments.
Yeah. One of the things that I think is a bit different about when I read about how you invest, and I read your quarterly reports, I read lots of reports that focus on the fundamentals and the bottom-up stuff that you've talked about. I don't know too many other managers that really draw on so many external factors from the big picture. You talk about technicals, you look at previous market highs, you look at equity risk premia. You're often looking at factors outside of the individual company to give you a read or a barometer on the market. How is this part of your quarterly report to keep investors entertained, or is it part of the process?
No, look, I guess I picked up some of those skills when I worked at ING Investment Management many years ago, and the equities team there made it their business to ensure that every tool in the toolbox was used in some shape or form. So your valuation work, your top-down valuation work on PEs versus bond rates, equity risk premium, as you say, it's relatively easy to calculate and keep an eye on. And those sorts of temperature checks, if you will, are critical for how you should be investing. Look, when you go to a foreign city, you want a roadmap. You need a map to get you through it and get you around. Technical analysis and technical indicators and oscillators and the like are that roadmap. So you do your fundamental work on what city you go to, but getting around, technical analysis is a valuable tool. And so myself and my team spend some time, and it's not a formal part of how we look at things, but it's certainly in the toolbox. So you've got your top-down valuation drivers and your risk settings. You've got your fundamental work, which of course derives what companies you are going to own and what companies you're deliberately not going to own. And of course your technical analysis will help you with the trend, when to buy, especially when you bought a stock, it's rallied, it comes back, you'll know roughly where support is, you'll know if a stock price that's retreating is picking up support or being rejected at old highs. All of that information is crucial in not only setting the portfolio, but keeping the portfolio true.
So can we bring some currency to that conversation and explain how that looks for you today? How are you positioned? What's the runway for your portfolio, your macro settings? What are they telling you?
Sure. Look, I've always said that a typical rotation when you've got to own a new sector takes about, you'll get 3 to 4 years out of a rotation. There's no hard and fast rules, of course. In mid-2016, we formed an opinion that it was time to dust off the folder for cyclical stocks, in particular commodity-based cyclical stocks. Mining service names, by way of example, Sims Metal, a whole raft of basic industrial type stocks, as well as resource stocks, looked interesting. We put the portfolio into that positioning. That is the positioning that we still have today. We have a portfolio that has a reasonable number, a good exposure to mining service names. We have a portfolio that is well exposed to energy because we've formed the view that the oil price had gone far, far too low on the oversell. We've got a nice exposure to energy stocks, a nice exposure to gold and a number of base metals as well. So the portfolio we put in place around mid-16 is the portfolio we have today. It feels to us, even though it also feels a little crowded, I've got to say, a lot of people are now saying they've got the same portfolio. The crowd can get it right for a period of time. So that portfolio setting we've got in place still feels valid. So I think looking forward, armed with what we know today, we don't think we need to make any big changes in the next 6 months or so with the portfolio.
Okay, interesting. I want to dig into some of you've been able to talk about a few successes along the way. I want to dig up a bit of pain.
Oh.
With the longevity that you've had in the industry, undoubtedly there's been some times where you've got things wrong. Talk us through not just where you got it wrong, but where you got it wrong and you've learned something that you still think is valuable today.
Yeah, that's a very fair question because every fund manager who's fair income will tell you that he gets a few wrong. In fact, he'll get a few wrong, and hopefully he gets more right than wrong. My experience, I've had a couple of situations that have not been great, and as you point out in your question there, you need to learn from that. In the late 90s, I remember being a big investor in a company called Discovery Petroleum, which was a Perth Basin oil and gas producer, and it was a fantastically managed business with a tremendous little reserve. It had great offtake agreements, it had exploration upside, it had all the elements of a successful business, and it was very well managed. And we owned a substantial shareholding in that stock, Discovery Petroleum. And you know what? The stock didn't do much. Over the years, it meandered. I think the range might have been 50 to 60 cents, and I grew bored of it. And I was the analyst at the time, and the fund manager also grew bored of it. And together, we decided we could probably do better. And I remember begrudgingly thinking, yeah, but the fundamentals are so good. The free cash flow yield on it was extraordinary. Someone's going to take this. It's just too good to be true. And out of boredom and monotony, we quit the position, and I think we could have been 6 or 7% of the business, and we sold it through boredom. And within about 8 weeks, it was bid by an international oil and gas company at a big premium to last trade. And I can't tell you how many restless nights I had in the aftermath of that. And I thought, what have I learned from this act of idiocy? And that was simply, in matters of finance, investors must be patient. Some stories just take years to play out. Some stories will, when you've got an obvious valuation discrepancy, it just takes a while for it to be unlocked and realised. Sometimes it's realised by other institutional investors who were blind to it. Other times it's a corporate event like that. And that was a hard lesson. But as a lesson, I guess, to this day, I hold close to me, because I know stepping off a story too soon or too late can be disastrous.
The other thing I want to pick up on is you've obviously had one of the few investors, not that many investors have been able to ride through the market cycles that you've been through. We're sort of 10 years, 9 years down the track on a bull market. Yeah. I think if you ask many investors what keeps them up at the night, they'd say it feels like this is getting pretty long in the tooth. Yeah. What's your sense on it?
It's a fair observation, and it's a process that we put ourselves through weekly. Has this market run too far? Is it overbought? Is it overreaching right now? I just want to tell you a quick story about. Investors will tell you, and lay people in particular will tell you, that nobody rings a bell at the top and nobody rings a bell at the bottom. So you just got to be in and out as an investor. And well, I've got to say that experience tells me that's not correct. I have been through 2 major market upheavals, 2 huge tumultuous periods, and I heard the bell on each of those 2 occasions. So the bell does sound. You've just got to know what the tone of the bell is. The first one was on the October 87 crash, a long time when I first started in the business, and I saw someone selling stock, a very, very sophisticated investor, very wealthy, selling stock. And I remember it was just the wrong thing to do at this stage of the game. And I remember my boss at the time saying that selling action from that person was the bell being sounded or being told. Now, I heard the bell as recently as the GFC lows, and when the market was despairing, investors were essentially giving up. It was around March, April 2009, and I took a phone call from a private investor, a very sophisticated, deep-pocketed private investor, that said to me, I noticed you're a substantial shareholder in Norfolk Group, which was an engineering air conditioning group. So that's right. He said, I'd like to acquire your 7% stake right now. I said, well, we don't deal with investors off the street, sir. We deal with brokers. And I said, can I ask what is motivating this? And he says, well, we normally buy, as a private company, we buy unlisted businesses. But it appears to me, with the way in which the market has traded and where it's got to and how depressed it is, that listed businesses are trading more cheaply than unlisted businesses. And that phenomena just doesn't happen. And he said, and when I see that, I know that I've got to start buying listed assets. So I put the phone down. I said to the investment team, I said, gentlemen, I've just heard the bell. If this gentleman's right, listed assets are now starting to trade below the valuations ascribed to unlisted assets. And that is a complete no-no. That is an insane situation, because in the real world that doesn't happen, of course. And so that gave us the comfort that all our valuations that were saying things are cheap, that we were feeling a little bit better, that it had all gone too far. The last piece was the bell. I needed to hear the bell, Jimmy, and I heard it, and that was the bell. So I guess you do hear the bell. Perhaps not always, but I've heard it on 2 occasions when it was absolutely mission critical to smart investing. So you're going to ask me now, have you heard the bell this time? And the answer is, I have not heard the bell this time. I'm not going to,
because both of those experiences sound like cases of identifying extreme levels of irrational investor behaviour.
Yep.
And so my question is not, have you heard the bell? My question is, to what level are you seeing irrational exuberance around the market?
Yeah, well, I can say with reasonable comfort that we're not seeing any great pockets of any great excess or exuberance in the whole. There have been pockets of exuberance, and actually I think that makes for a healthy market. It's not across the board. It's the pockets that are associated with the lithium surge. And then, of course, we had the cannabis stocks some time ago that did their thing. So there are pockets of enthusiasm and pockets of almost, at times, irrational pricing. But the sum of the parts doesn't make the whole. And essentially, this market is on any valuation metric you want to use, it's on a fair footing. It's not cheap. It's not as expensive and as overpriced as it has been over the last 10 or 15 years. It's on a fair footing. The behaviour from investors, the behaviour of corporates, the behaviour of brokers is in no way resembling a euphoric market setting. I think that we are moving into a euphoric stage for the market, especially in the United States. You know, the 4 stages of an equity market: pessimism, scepticism, optimism and euphoria. I think no doubt about it. So John Templeton was right. They are the 4 stages. I think we're at the beginning of the euphoric stage in markets. But I think we've got a fair way to run just on that measure alone. Not to mention bond yield, earnings yield, valuation metrics, equity risk premiums and so on. Make me feel reasonably comfortable at the moment.
One of the things I wanted to talk to you about is the exposure that you have to the new businesses that are coming on to the ASX. Small companies, we know, will always be populated with small industrials, mining companies, mining services companies, which you've talked on. But 2 years ago, you talked at our conference and you said you felt like the constituents of the small caps was the best that you'd seen in your history. 2 years down the track, I'd like to hear or learn about some businesses that you think are really proving themselves up that may not have existed 5 years ago, things that are new, that are really gaining credibility in small caps.
Sure. Well, there's I mean, where does one start with that subject? Especially if you go a little deeper than the small company rump we manage. If you go into that next bracket, the emerging company or the microcap space, there are stocks born every other month. Look, Afterpay Touch is a great example. It's a prominent stock in our portfolio positioning. It certainly has been. That's an example of a business concept, an online lay-by, by another word, by another expression. Basically, that concept didn't exist. That company didn't exist 5 or 6 years ago, more or less. But the one thing that we were able to fasten onto was we had familiarity with one of the senior executives, and we'd seen him in a previous guise, and we saw how he conducted himself, and we saw that he'd turned up with this business called Afterpay. So we through him sat down and got to know him, and then met his sidekick, and between the two of them, they have built a business that didn't exist 5 or 6 years ago. That is almost, and I don't want to over-egg this, Jimmy, but almost a revolution in how people shop, especially millennials these days. And it's finding fast appeal and fast attraction locally. It appears that they're gaining traction internationally as well, in the US in particular. We're also seeing businesses, what always amazes me, businesses that have traditionally been steady and consistent and high performing, such as Reece, the plumbing services group that's been going since the late 60s. All of a sudden, at this very seemingly late stage of the game, choose to almost go to a new growth horizon and buy and acquire a business in the United States, and then take on a business over there. So that's a business that's been existing, that's almost been not predictable. Well, it has kind of been predictable. Reece has been an extremely high-performing business, but now is taking on a whole new dimension and going off to the United States and actually going to try and replicate, I guess, in essence, what they've done so successfully here. So I think that's the beauty of our space, is not only do you get new businesses born, especially at the microcap end, that's where they start from. You get existing businesses that may or may not have been strongly performing actually reinvent themselves and grow themselves out. I sometimes make the observation that the ASX 100 today is basically comprised, in fact, over 40% of the ASX 100 today began life as a small company when I first began as a small cap manager. So you can see that the trajectory of some of these businesses with the right management and the right industry backdrop and a bit of success, the results can be absolutely spectacular, and you can end up an ASX 100, which is the ultimate vindication for a business. You become an ASX 100 stock, and 40-odd% of them today started on my watch. That's pretty incredible.
For the investor on the street, and I'll use Afterpay as an example, you can be exposed to the bull case and the bear case for a company in its early life cycle. Just today, there's articles in the AFR quoting the bull and the bear case for that stock. What stress testing do you do on companies where the history of the company is short, the concept is new, the market is large, but to go into the US, it's unknown. What are the stress tests that how do you get comfortable?
Probably the easiest way, the smartest way to do it is become a customer. Transact yourself. Get on there and transact a variety of different products and talk to your kids. They might actually already be using it. In the case of Afterpay, my daughter was alarmed that I'd even heard of it, and that all her friends, it's become the millennials' new currency, using Afterpay. So apart from yourself, familiarising yourself with it and using it and becoming a customer, following it on Instagram is one of the things that our analyst is doing. He basically follows them, and he follows as a client is appointed, or a new service provider is appointed. He takes to Instagram and follows them and just gauges the feedback. So I guess you're doing all those sort of intangible things. You can't put a dollar value on that sort of stuff, but you can you can build your confidence and your comfort up that from the heartland, from the grassroots, you're getting feedback that supports the model.
Customers are responding to
it.
Yeah,
correct. And when we go and visit retailers, in the case of Afterpay, when we go and visit the other listed retailers, we say, "Have you heard of Afterpay?" So we do the third-party validation thing at a corporate level, and then get their feedback as in terms of the experience. And it has basically been, almost universally supportive and bullish on Afterpay. So there's all those sorts of things, Jimmy, that you employ as an analyst and as a fund manager to try and get comfort. You can model the story and make your own numbers up and really talk yourself into a lather. But it's also good. You really have to get down and just be as the consumer is and try it firsthand and see what you think. So that's what we've done, a bit of that to get comfort. And then even then we're still not comfortable. We're always worrying about the next thing that might derail it. Where will this investment thesis be wrong? What have we overlooked? Have we misread the individuals? There's all of those emotions and all those questions that keep coming up.
You've been in this business multiple decades. Ely Griffiths Group is established, it's on a sound footing. You have your flagship fund, a new fund in the works. How do you stay motivated and focused, given that there's been a lot of success that's come with the role?
Yeah, well, at the risk of sounding a bit cliched, work-life balance plays a big role in maintaining motivation, and I include staying physically fit and mentally alert. I'd include when you have downtime outside of the office, that's recharge time. That's time to pick up a book on something of interest and just escape for a little while, because this business is all engrossing. This business has you minimum 12 hours, sometimes 14 hours a day, locked in. So it's very much about how you manage that balance of sort of when you're off duty. One thing that I found incredibly motivational along the way is picking up some of the international books, the books that are written by either autobiographical or biographical of leading traders and successful money managers and successful business operators. And just reading those books I find extraordinarily motivational. Daniel Yergin's book, The Prize, which details the long history of the oil and gas industry, from the first discovery of leaking oil in Pennsylvania right the way through to the oil industry we have largely today. I find those books not only educational and uplifting, but they're incredibly motivational. And I encourage the guys in my office, the team in my office, to read. And if I log on and go to Amazon and buy a book on a topic that I'm looking at and excited about, I might just buy 4 or 5 of them and give them to the guys to read. So I think keeping your mind active with managers and operators that are far superior in their expertise and experience than we'll ever be, being stimulated by that is great. But also your work-life balance, Jimmy, keeping fit, training, eating well, looking after yourself. All of that goes to a successful operator, a successful manager.
And is your passion for investing the same as it was when you started?
That sure is. It sure is. I mean, I get as much, as I said before, if you're doing it just for wages, you probably should leave the business. I mean, it's not about that. I still get a heck of a buzz when we get a stock right that rallies and we do well out of it. And I still get very down and get myself I get a bit cranky with myself when a stock doesn't go according to plan, that I might have bought it too soon, or I walked into a trap or a setup that wasn't right in the end. And so I still beat myself up on that. But look, I think a good investor, a true investor, an investor that's been blooded in properly in the first place, I think is an investor all his life, and takes that through retirement, takes it into your late years, and you'll always be keenly devouring market information, and you'll still have that, you'll have that thrill that a winning stock gives you. Sometimes it's a thrill only a winning stock can give you.
Well, Ben, appreciate you taking the time to come and have a chat, sharing your insights and a few of the lessons that you've picked up over what's been obviously a really successful career.
Thanks, Jimmy. It's great to be on. Thank you very much.